When developing a business plan, it's important to consider your business's finances. Even profitable businesses can go broke if they do not know how to properly manage their assets, income, and expenses. There are certain questions you will want to ask yourself about your business's finances, such as how will your business be making money? How will you manage your business's money? The single most important analysis in a business plan is a cash flow plan, because cash is the most critical element in business. Let's now take a few minutes to go over some financial concepts and terms that will be useful when developing your venture's business model. This is Sarah. Sarah has her own business selling wooden clogs. Last week, Sarah sold 50 pairs of clogs for $10 each. Let's now look at Sarah's income statement for the week. We can see that the top line of the statement shows us how much money Sarah made in sales for the week. This top line is also known as Sarah's revenue. This week, Sarah made $500. However, after accounting for all of her expenses, we can see that Sarah is left with $200. This bottom line value is also known as her net income. You are now the proud owner of a widget business, and your business starts off with $100 in capital. Here is an example of how your widget company might set up a very simple financial statement. We can see that your company is just starting off and has made no sales and has incurred no costs. We do, however, see that you have an initial $100 in capital, which is seen in your bank balance, which is highlighted in yellow on this sheet. Your business is responsible for selling widgets, but you don't have the desire or technology to manufacture them, so you want to purchase widgets from a widget manufacturer so that you can sell them to your customers. You can buy a widget from the manufacturer for $100, and you can sell the widget to your customer for $150. The difference between what we can buy and sell the widget for ends up being your profit. In this case, your profit is $50. Congratulations, you have just sold your first widget for $150, which you will now go put in the bank. After selling your first widget, you can see that you have a combined total of $150 in the bank. We used the initial $100 in capital to purchase our first widget, so we deposit the $150 we sold the widget for in the bank. It's the same thing as if we had kept the $100 in assets in the bank and deposited the $50 profit. Looking back at your financial statement, you can see that you have $150 in sales and $100 in cost of sales, which means your profit equals $50. This profit is now added to your bank balance, so we can see the balance has increased from $100 to $150. We now repeat this process for a second and third widget, and at the end we find ourselves with a total of $250 in our bank account. So far, your widget business has made $450 in sales. You sold 3 widgets at $150 a piece. However, it cost you $300 to purchase the widgets from the widget manufacturer because you bought each widget for $100. Therefore, in the end, you have made a profit of $150. This makes sense because you started out with $100 in assets and made a profit of $150, which means that you have a total of $250 in your bank account. After selling 3 widgets, this is how your financial statement might look. You have made $450 in sales, and it has cost you $300, which means your profit was $150. By adding our profit of $150 to our original $100 in capital, we now see our bank balance is $250. Managing your widget business's finances seems pretty simple right now. However, the example we have created is far from reality, because it assumes that all customers are going to be paying with cash. Usually, businesses make agreements that customers are given a certain amount of time to repay the full amount of the product or service. This is called accounts receivable. Similarly, businesses make agreements with their manufacturers so that they also have a certain amount of time to pay their purchases in full. This is known as accounts payable. How will accounts payable and accounts receivable influence our income statement? Both sales and profit will remain the same. However, because we sold on credit, we won't have money available in the bank immediately after a transaction is made. This will be very important to consider when thinking about future transactions. As we have seen, business plans depend on both words and numbers. Analyzing a venture's cash flow and understanding where the venture's revenue is coming from is extremely important, because cash is one of the most critical elements in business. In order to do a cash flow plan, one will need to look at both income and balance sheets, as well as consider sales, cost of sales, and various expenses that the venture will incur. In other words, to do a sales forecast, you need to understand your market. Step by step, we have seen how a venture's business plan can become a collection of tables and charts around the text.